Howdy everybody. So I was giving some thought to purchasing newer, better equipment, possibly as far as buying a brand new truck. And I was like, well, how big of a truck payment do you want, or how much truck payment should you have? You know, is there a rule of thumb that says, you know, your truck payment should be approximately such and such amount? You know, is there a concept of truck payments too much or truck payments too little? You know, what's the sweet spot, for example, for truck payments? You know, I've driven old trucks where I did not have any truck payment and it broke down all the time. You know, so what it cost in repairs, I could have made a truck payment. Okay, we're back. So not only did I not have truck payment, I had breakdowns, and then I wasn't able to deliver the load. You know, it was poor customer service. So this is a really bad way to run a business, to have an old truck that breaks down all the time. You know, so when I think about truck payments, you know, there's a lot that goes into this, but some of it, you know, revolves around how much you have for a down payment, for example. So, and then you got to think about monthly payments. And if I look at it from a percentage standpoint, because I think percentage works best in this scenario. If I say, okay, what percent of my net income per month would be a good range to have a truck payment? And what I concluded was somewhere between 20 and 30%. So for example, if your net income after all your expenses are paid is $10,000 per month, then it's perfectly comfortable for you to spend 20 to 30% on a truck payment. So 20% of 10,000 is 2,000, 30% is 3,000. You know, if you get much higher than 30%, you're really kind of setting yourself up for trouble down the road. So let's just say, for example, you're going to go 40% or $4,000 per month truck payment. I mean, that's a lot. Can you do it? Theoretically, yes. You know, theoretically, you could go up to $10,000 per month truck payment. Do you want to do that? I don't. You know, and why is that? Well, it's because the freight market, even in contract freight, goes up and down, up and down, up and down. Good times, bad times. You know, it's like, well, you made your calculations based on good times, and you didn't take into account what kind of miles you're going to get during bad times. So, you know, if you want to try to play it relatively safe, you know, you got to think, well, during the worst case scenario, I'd probably get 2,000 to 2,500 miles per week, or about 8 to 10,000 miles per month. If that things are really, really slow, which does happen from time to time. You know, and you got to think, oh, how are you going to make your truck payment if, you know, the economy goes into a recession and, you know, you can only get 8,000 miles for the month or 10,000 miles for the month. Hopefully you can do better, but do you really want to gamble, you know, and say, well, the economy is always going to be strong, so therefore I can afford a much larger truck payment? You know, that's kind of risky, especially for a newer owner-operator. Now, if you got money saved, like we often talk about saving your first $100,000, then you have something to fall back on during hard times, so then you may want to take on a little more risk. But let's say, for example, you don't have $100,000 saved, you know, and, you know, it's like, well, yeah, you can afford, you know, a big truck payment, but, you know, what are your priorities? Is your priority to have a nice truck or to start saving money towards that $100,000 goal? Because ultimately, you're going to be better off having saved the money and reaching $100,000 in savings rather than driving newer equipment. Driving newer equipment's nice, but if you're just starting out, you know, I'm sorry, you got to put in your dues. And part of your dues is you're going to drive older trucks. So, and if you have debt, you have student loan debt, you have consumer debt, you have car loan debt, credit card debt, you got to think about that when you're thinking about how much truck payment you want each month. So it's like if you don't have any debt, then you may be willing to take on a larger truck payment. But if you have debt, then your priority should be a lower truck payment so you can pay off that debt. Lower truck payment so you can save up to $100,000 with no debt. And we're talking years. This is going to take you years to do. If you're starting out, let's say for example, you're starting out as a new owner operator, you got $25,000 in debt of some kind, that's not truck related, okay? And you don't have any money for savings. I mean, you have enough for a down payment on a truck, but that's about it. Does it make sense for you to go out and buy a $100,000 truck? No. You can get a reliable used truck, for tens of thousands of dollars less. Always get the warranty. It's not so much the truck payment, it's the truck repairs. Truck repairs can often exceed truck payments, so you definitely have to have the warranty. So what you would do is you take a lesser truck that gets you closer to maybe 20% of your net income. So let's say your net income is $10,000 a month. 20% of that would be $2,000. Okay? That frees up your other money you earn that month to pay down or pay off that debt, that $25,000 of debt, and put you on a path towards saving up to $100,000 in savings, so you can reach, a level of financial security going forward. Because you want to think about the power of compound interest on that $100,000 that you're going to have invested, whether it's in an IRA, a 401k, or individual brokerage account. That's going to be setting you up nicely. You would have no debt. You would get $100,000 invested. Then, as this is going to take you probably 5 years to do that. Then going forward, you can look at buying newer, better equipment, which is fine. It's perfectly fine. You have no debt. You got $100,000 saved for investments, and you can afford newer, better equipment. And I would stick to the rule of thumb of 20 to 30% of your monthly net income, for a truck payment. So instead of having a truck payment of $2,000, now you may want to reach for a truck that's going to have a monthly payment of $3,000 per month. You're going to have a more reliable piece of equipment, less miles, better ride, and you're going to have the financial security to go along with that, because you're going to have that $100,000 saved up to fall back on in case things go sour. So I would not recommend going above 30% of your monthly net income. It's just that if you do, you're not going to have money for anything else. You ever hear those guys who are house poor, and they're house poor because they can't afford to do anything in life because all their money is going towards their house payment. Yeah, they have a nice house, but they can't go golfing with the buddies. They can't buy a boat. They don't have a motorcycle. They don't have anything. All their money is tied up into a house. You could do the same thing with a truck, because a truck is as expensive as a house. You could be truck poor. All your money is tied up in your truck, and you can't afford to do anything else. So I would not recommend going above 30%. So let's say, for example, you want to buy a brand new truck for $200,000. Okay, you could do that. How much down payment should you put down? Well, you do the math and you figure out what size down payment will it take to get your truck payment down to $3,000 per month. Because we're going to base this on like 10,000 miles per per month, or $10,000 net income per month. So you want to, if you're going to do 30%, then your truck payment was going to be $3,000. So in order to have a $3,000 truck payment, I mean, we're doing the math in reverse. Then you got to figure out how much down payment on a $200,000 truck you would have to put down, and it's going to be close to $50,000. You know, you have to put down $50,000 on a brand new truck to get your truck payment down to $3,000 a month. Now you could do 5-year increments. You could do, I think you could do, you know, 7-year increments. You know, whatever you're comfortable with. If the math comes out that's less than 30%, you know, or close to it, then that's fine. You got to keep in mind that, you know, the newer equipment's going to have trade-in value. You know, so when you buy a truck, say a $100,000 truck, and you drive it for 3 years, okay, it's no longer worth $100 because it's depreciated, but it is worth something. You know, so maybe when you bought it, it had, you know, 350,000 miles on it. You drove it for 3 years, and now it's up to like 600,000 miles. You know, maybe more, maybe a little bit more than that. But you know, how much is that worth when you go sell it or trade it in? Well, it's probably worth at least 20,000. You know, so if you take 100,000 minus 20,000, then you're really only paying 80,000. And if you put, you know, $20,000 or $30,000 down payment, then you're really only going to be paying off about $50,000, and then you can kind of figure out what your monthly payments would be. So, you know, there's a lot of massaging of the numbers, you know, that you can look at the interest rates, you can look at the loan term, you can look at how much down payment you're putting in, how much you think you're going to get when you sell it or trade it in, you know, and you know, just do the math. Does it come out to 30% or less? If it does, you're probably in good shape. You're probably safe to buy. You know, it's like, well, that fits my budget. You know, I should be perfectly okay if I stay below 30% of my net income. If it comes up higher than 30%, then you got to really think twice before you pull the trigger on that. You know, it's like you're setting yourself up for some hard times. You know, because the economy goes down and the miles go down, you're not necessarily going to have all these miles to make that truck payment. That's where guys get themselves in trouble. You know, it's like they think, especially guys on the stock market, I see this all the time. You know, the rates are really good, so what do? They go buy a brand new truck, and then the rates come crashing down, and what happens? They can't afford that truck. You know, so you don't want to be in that type of scenario where you can't afford that truck. So, you know, just do the math. Say if it's less than 30% of my monthly net income, that's perfectly safe. You know, if it gets up to 40%, 50% of your net income, you're taking on a lot of risk. You better hope everything goes perfectly. And you probably won't have money to do anything else. Instead of being house poor, you're going to be truck poor. So it's like, you know, you're hauling contract freight. It has a limit on your earning potential. You know, I would use a rule of thumb of $200,000 per year gross revenue. You know, that means your net income is probably going to be close to $100,000, maybe a little bit more. But a big impact on these numbers is going to be the size of your truck payment. You know, the bigger your truck payment, the lower your net income. The lower your truck payment, the larger your net income. Then there's tax advantages too. You would have to think about, you know, how it's going to benefit you in saving on taxes. If you're going to have a larger payment, it could help lower your taxes. If you don't have any truck payment, then you're going to pay more in taxes. You know, and then there's going to be tax incentives. You know, whether you can write off the cost of the equipment from, you know, based on the changes in the tax law. You know, so these things always have to be reviewed with the accountant. You know, they can advise you from a tax policy standpoint does it make sense to have a certain level of truck payment? So you could run with no truck payment. You could run with an old truck. You will get no tax advantages for doing that. You have no depreciation value for doing that, and the truck will break down quite often, and you'll have the cost of the breakdown plus the lost opportunity cost, that money you did not make because you're breakdown. So if you broke down and the repair is $5,000, but you're down for a week, that cost you another $5,000 in lost revenue. You didn't make it. Otherwise, you would have made it. So the true cost of that repair was $10,000. Well, if that happens 3 times a year, that's $30,000. $30,000 is, right? You would have been better off making a truck payment than running with an old truck, because a truck payment would have given you more reliable equipment, tax advantages, and it would lower your tax liability. So there's many advantages to having newer equipment, better customer service, less headache. So you don't want to be broke down on the side of the road all the time. So these are the things you got to think about. You're like, well, should I buy a truck with 300,000 miles versus a truck that has 400,000 miles? And it's like, well, 300,000 is better than 400,000. You look at that warranty, and you look at how much down payment you're going to make, and what the interest rates are, and the length of the loan. And I would suggest if it comes in at 30% or lower of your net income per month, you should be fine. If your numbers come up high, then it's too much truck. You can't afford it. If you can't afford it, what does that mean? Well, it means you need to save. If you really want that truck, that means you got to save more for a down payment. Just raise your down payment. And maybe that means you don't buy it for another 6 months. But you get that down payment, a larger down payment, then you lower your monthly payments. Come in at 30% or below, you should be good to go. All right, guys, that's all I got for you. Thanks for watching. See you on the internet.